In the near term, there is downside, maybe to 2,500, but that's minor compared to the upside of trying to discount a super cycle. So we think ETH can be 7,000, 9,000 by the end of January, and that's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter.
Tom Lee begins by reminding us of something seasoned investors already know but often forget. Crypto always sniffs out macro shifts before the rest of the financial system. Bitcoin and Ethereum don't wait for Wall Street's permission to move. They respond instantly to changes in liquidity, interest rate expectations, and Federal Reserve posture. And that's exactly the tension we're facing now. According to Lee, the Federal Reserve is sitting in one of the most complicated, politically sensitive positions it has confronted in decades. From a pure economic standpoint, stripping away politics entirely, the Fed should already be cutting rates.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Crypto was the first really to sniff out and it's going to be responding to a Fed, right? And if the Fed remains hawkish and executes policy error, that's bad for crypto prices. That's why it's really important for anyone involved in crypto to understand that what the Fed's going to do is a big deal. I think the Fed is in a very difficult spot because if there wasn't what looks to be as political interference, I think the Fed would be cutting without question now, because bond market is showing future inflation expectations are falling, and that means that if monetary policy doesn't adjust, its real rates are getting tighter. We're actually putting more tightening into the economy. But as you know, the Fed has to make sure its actions don't look like they've been politically driven.
Yeah.
And that, not just the market's perception, right? Because people tend to think of it as, oh, well, this is the bond market or stock market's conclusion. That's not really what I think that what the Fed's concerned about. It's really the integrity of the organization. They have 30,000 or more employees, and each of them is seeing this relentless attack from the White House. So I think to the extent that the Fed governors and the voting members know that it's the morale of the institution that's at stake. So this is why the Fed is even more guarded in their actions and much more deliberate in their messaging, because they don't want anything they do to look politically motivated. And unfortunately, that's been bad for markets, because the markets have interpreted that as the Fed is hawkish. And I mean, they do sound hawkish. So I think it means that there's going to be an alignment in later months when inflation is fallen enough and the Fed can now make cuts where it's no longer viewed as politically motivated. Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on-ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper-volatility. It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. He is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's market makers play a big role, but there's someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. I mean, that's what he thinks makes a bottom. So it would, I think, be a better situation to see crypto prices bleed lower to 2,500. But it could reverse at any time, because markets don't have to do what ends up being an ideal scenario. Crypto has declines, and we're not necessarily in a bear market, and it feels terrible. In fact, that's what you have to be mindful of, is that it's a hyper volatile space. So it feels terrible now, but just like in 2024, crypto felt terrible for many months, and then we've had these big moves. I think, in the near term, there is downside, maybe to 2,500, but that's minor compared to the upside of trying to discount a super cycle. So we think ETH can be 7,000, 9,000 by the end of January, and that's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter.
Tom Lee ends with what he believes will be the largest unlock of the next decade, the complete tokenization of assets. The dollar is already digital. This is what stablecoins represent. And stablecoin issuers, like Tether, are approaching valuations rivaling the world's largest banks while employing a fraction of the headcount. Over the next 10 years, 70% or more of global innovation will be digitally native. Assets will become tokenized, markets will trade around the clock, and liquidity constraints will be solved with software-driven market architecture. The transformation will be as big as the move from physical communication to digital communication, and crypto is the foundation layer for that shift.
What is Bitcoin? I think everyone really accepts it as it's a store of value, a really good way to store value, and that's accepted today. In fact, someone might say that's like a Lindy effect, that people believe that. When we first started writing about Bitcoin in 2017, and digital gold was one way to sort of argue Bitcoin's value, it was not accepted because many people said, well, come on, I mean, it's just code. I mean, how can code store value? Or why can't there be 100 Bitcoins? Or look, I could create a new Bitcoin tomorrow, or I could fork Bitcoin and create a new Bitcoin, or I can't buy. I remember one client saying they couldn't buy a bottle of water with Bitcoin, so how could it even be valuable? So, but of course, all those arguments fell away. And now we have digital gold, Bitcoin, store of value. Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, you still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain. And it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does. But they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the big banks, the blue chips, build stable coins, and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factorize a stock. So just like in the bond market where you can factor a bond, we can factor Tesla so that you're only buying the implied future value of Optimus Prime. So instead of asking Tesla to make itself a tracking stock, you can synthetically create that on the blockchain. So you can't really do that on Bitcoin. So you have to build it on a smart contract, L1 or L2. And the reason I think Ethereum is going to be one of the leading platforms is, number one, its sheer size. It is by far much bigger than the number 2 or number 3 L1s. It has a huge and growing developer community that is really dedicated, and it's global. So I think it's a true, robust community with actual known values. And it's a neutral blockchain with 100% uptime. So I think that this becomes one place where it's going to be easier for people to create innovative products. So for instance, let's say JP Morgan or Goldman want to just do tokenized stocks in 24/7. And they want to control as much of that as they want, as they can on a blockchain, because you lose a bit of control. They may not necessarily say they want to do a lot of this on Ethereum, but then someone's going to come along and create a product that does do this, and it's supported by a community, and then it gathers all the liquidity. That's exactly what happened with something like Polymarket, right? On a prediction market basis, where it came natively out of the blockchain and today broke out into the real world and is, look, it's the most cited way to actually understand events in the future. I mean, it's the Polymarket is the closest to having a crystal ball today. Like, it is the closest to tomorrow's newspaper, and it's a native blockchain product. It didn't come out of an existing Wall Street desk that created this product. It was created by builders. So that's why I think Ethereum, and it doesn't have to be only Ethereum succeeding. I think Ethereum, there will be room for others, but I can see the clearest roadmap for Ethereum succeeding. The dollar, which was already now synthetic, became tokenized on the blockchain. So now the dollar is now digitally represented. And that's what a stablecoin is, because it's backed by treasuries, but it's still basically just a digital dollar. That is going to be creating the roadmap for a lot of other assets to become digital, tokenized on a blockchain. And it's a big deal. We know that in crypto, for instance, the projects that have actually emerged from as native blockchain products have actually been better mousetraps. And that's something that is driving and sending Wall Street to build. The first of these has been the stablecoin and Tether. And Tether, as an entity now, it's valued, and they're raising at what is reported to be $500 billion. That would make it the second most valuable bank in the world. And even if it ends up raising at 400 billion or 300, whatever that number is, they're still the second most valuable bank in the world after JP Morgan, which is 869 billion. So a company that has today maybe 300 full-time equivalent employees is almost as valuable as a bank like JP Morgan has 313,000 employees. So there's a lot happening. There's a lot of benefits that come from tokenization, and I think that that's the big unlock that's coming. When something becomes native digital, it works really well. There's many examples. For instance, crypto trading 24/7 is an example, but look at how we do all communications. It is all native digital now. Emails are digital, or, messaging. And in fact, over the last 10 years, I think it's a low estimate to say that at least 50% of all GDP growth in the last 10 years is native digital. It's probably now close to 60%. In the next 10 years, it's probably going to be, 70%? So increasingly, almost all innovation and growth is native digital, and yet we're using geographically defined currencies, and we're trading instruments only 5 days a week with specific market hours, even though during those market hours, 99% of all the trading is already electronic anyways. I think one of the challenges as we tokenize is, of course, going to be making sure there's still the same liquidity that's available, because we know one of the glitches in crypto is liquidity is not universal. And so we do want to make sure prices are correctly reflecting a deep and full market whenever we see a price posted. But that's, of course, software. I mean, someone can define prices correct or put limits on price change if necessary.
Yeah. Tom Lee's message is clear. The current volatility may be painful, but it is not the story. The real story is the structural transformation of global finance, a shift driven by tokenization, digital assets, decentralized rails, and a generational re-architecture of how value moves. Crypto does not rise on hype. It rises because it solves real problems, and the institutions that once fought this industry are now quietly building their future on it. If you found this expert breakdown helpful, make sure to like the video, subscribe, and turn on notifications, because we'll continue translating the most complex macro crypto insights into clear, actionable narratives you can use to stay ahead.